Goldman Sachs has come out with their India macro outlook for 2016, and I have with me Tushar Poddar, who's the India chief economist at Goldman Sachs, to discuss that report. Tushar, great to have you in the show. Thanks very much for taking out the time to speak with us. When I read your 2015 outlook, you were very optimistic about India. 2016, the outlook seems more toned down. Could you explain why?
I still think we're positive. I still think that we are predicting a cyclical upturn in growth, which is a lot more than what we are predicting for other economies globally. India remains the fastest growing economy globally, and especially at 7.9 for fiscal year 17. That's a pretty strong growth rate. So I think that based on domestic demand factors, given an environment where external demand is acting as a drag, I think that's still pretty good.
You think that India would be impacted more by external demand in 2016 than it was in 2015?
No, I think 2015 was bad enough on the external side. I think we had exports contracting by 15 to 20% through the course of the year. And clearly the base now has become very low. So in that sense, the exports should show a sequential improvement. Also because some of the commodity price declines have already been reflected in the trade numbers. So while the challenge from the external side remains, I don't think it's going to be a further worsening of external demand in 2016.
But from 7.5, you're expecting growth to come in at 7.9, largely led by high productivity. You're making a case that India doesn't really need that much capex push coming in via the manufacturing route. Just the productivity going up in the services sector can do the trick. You're talking about essentially focusing on education, technology, as well as ease of doing business.
Yeah, so I think we should distinguish between cyclical factors and structural factors. I think the India's growth potential is going to be driven by things like technology, the improvement in internet penetration that we're seeing, the exponential increase actually that we're seeing, the improvements in education, the improvements in ease of doing business. All of this leads to an improvement in potential growth. The cyclical upturn in 2016 though will be driven more by government capex and private consumption demand. So we've already seen some indicators of that over the last few months, and I think that trend might continue. There are external risks, but I think domestically, given that monetary policy is already loose and fiscal policy has been geared towards capital spending, that can act as a growth boost to the economy.
But not more than 125 basis points of rate cuts that we've seen so far. You don't think the RBI will move much more than that?
No, I think we've seen enough rate cuts. I think, as the governor said, we need to see the transmission of that into bank lending rates and through the wider economy. There's no point in the central bank cutting rates more if it's not going to matter at all. So also the risks to inflation are now to the upside, partly because of weather conditions. We've had two bad monsoons. We've got a severe El Nino. We've seen what weather conditions can do to places like Chennai. So we have to be very mindful of the impact on the food economy of extreme weather conditions. Apart from that, you have a pay commission wage hike, which is probable. So I think the risks to inflation are clearly to the upside for next year.
Does that also mean that you think the government would not be able to keep its targets on fiscal deficit? You've also predicted, or rather forecast, an expansion in the current account deficit as well.
Yeah, I think the current account deficit expansion is mainly because domestic demand is going to be stronger than external demand. So our imports are going to grow faster than our exports. On the fiscal side, it will be a big challenge because you've got a lot of spending commitments for next year. Not only do you have the wage hikes.
So 3.9 will be a miss this year, 3.6 will be a miss next year?
No, 3.9 I think they will be able to maintain simply because of the windfall gains in oil excise revenues that they've had, along with the one-off, the transfer payments from the RBI, etc. Next year is going to be a big challenge because it's not only the pay commission wage hikes and OROP, but also the fact that they have to consolidate further. So you have to go from 3.9 to 3.5, which I think is going to be a big challenge. So we will wait and see what the budget is like, but we will. I don't think that they're going to cut back significantly on capital spending.
Okay, I'll tell you why I thought that 2016 seems, for your report, seems less optimistic, because you said that the road ahead from here looks bumpy.
Yes.
What are the bumps that you see?
Yeah. So absolutely, I don't think that any economy grows in a linear path, and I don't think growth happens linearly. We saw that this year as well. Q1 was very bad. and then things have picked up in the second half of the year. The bumpiness comes from partly the external side, the Fed rate hike and slowdown in China. If you get a one-off deval in the RMB, that could have a big impact on India, and that could be a bumpy ride. So I think it's not going to be smooth. We want to see reforms. We want to see domestic demand continuing to pick up. That can sort of alleviate some of the bumps, and of course the bumps from weather. I mean, what this year has shown us is that weather conditions should not be taken lightly.
What about bumps in reforms? I mean, you've spoken about how the nuts and bolts reforms have happened, but in terms of the key reforms, how much can GST change a perception of India globally?
I think the world is really looking at a few, big bang announcements, and I think GST is one of them. So I think it's important for investors to get GST done. So apart from that, I think just movement on things like the bankruptcy code, things like resolving the state electricity board issues, the distribution, power distribution issues will be important. I think that moving to an MPC is also seen as a big improvement over the current monetary framework we have. So I think investors will be looking out for all of these. GST is clearly the banner right now, and is being watched very closely. So the smoother it goes and the faster it happens, the more positive the India outlook looks.
Okay, and what about infrastructure investment? That's been a key driver, seen as a key driver for growth, and there's been a lag there. How do you see the road ahead for infrastructure investment?
I actually see the road for infrastructure investment as looking good, partly because of the railways and highways ministries, which are actually, putting a lot of resources and a lot of commitment to increase spending. And if that is buttressed by some reforms on the power side, then the infrastructure sector looks like the key sector to drive growth in this economy.
One of the other concerns you highlighted was, the leverage on corporate balance sheets, NPL problems with banks. How do you see that panning out for 2016? Do you think there's going to be perhaps more ease there, more cleanup, and a better state of functioning for corporates to start looking at their investment?
Yeah. So on the corporate leverage side, a lot of that leverage is concentrated in a few sectors, 3 or 4 sectors, materials, commodities, industrials, utilities. So, there's no easy solution to that. It's got to be done on a case-by-case basis, but it's actually a very small proportion of total market cap. It's a high proportion of capex, but a small proportion of market cap currently. So that has to be done on a gradual basis. I don't think there is an easy solution to this. It has to be the non-levered part of the private sector which is going to drive growth. The consumers, the IT, the autos, these are the sectors which will drive growth rather than the highly levered corporate names.
Okay, let's talk about the currency view as well, because in all the things that we touched upon, that is pretty much central to foreign interest coming into the country. You're looking at a level of 67.5, but you're saying that the downside risks are high given the global environment and the Fed rate hikes, as well as the outlook on inflation. Explain that for you. I mean, how can the performance of the currency get impacted, and by how much to your forecast in lieu of things going not as per expectations globally?
I think we have to distinguish the currency forecast between a dollar view and an INR view. So the INR view, which is relative to the rest of currencies, remains pretty strong because in most likelihood India will run a balance of payments surplus. The current account deficit is weak. We think it's going to expand a little bit to 1.7% of GDP, but it's still below 2%. And FDI flows remain very strong. So I see against relative to other currencies, the rupee outperforming. But relative to the dollar, it's going to be weak because the dollar is very strong. And if we get the kind of rate hikes that we expect and the kind of flows that we're seeing towards the dollar, especially as the ECB and the BOJ remain in easing mode, I think that the rupee will continue to depreciate against the dollar. The risk is really an RMB devaluation. If you have a one-off RMB devaluation, then the INR gets hit.
How significant of a devaluation do you expect? With numbers going out between 6.5, 6.55?
I think it's a risk rather than a central case. It will depend a lot on what the PBOC believes is the right path for the RMB. We're not expecting a large devaluation. It's a risk rather than a base case.
Within 5%, you think?
I think one can expect a gradual depreciation further out in the next 6 to 10 months, but not an immediate sort of sharp devaluation of the currency.
I was really taken aback by the expectation that aside of this Fed rate hike that everybody is expecting on December 16th, you're looking at 100 basis points in hike in the Fed funds rate over the course of 2016. That's fairly aggressive, more than what most would expect.
Yeah, so the driver of that view of our US team is that the slack in the labor market is completely over now. Unemployment rates are now down to 5%, which is pre-crisis levels. And there is incipient wage pressures emerging now in the US. So having met the unemployment mandate, the Fed is going to start focusing on the inflation mandate and normalizing monetary policy. And that would require well-signaled but gradual rate hikes. So 1 a quarter next year is what we have
But that would also change the stance for the Fed, which has largely been dovish so far, to take a complete U-turn and sound hawkish. That would be quite a road to travel.
Yeah. So I would say that the overall policy environment remains accommodative, especially if you look at G3. BOJ and ECB continuing to be easy. So I wouldn't sort of just read the Fed rate hikes as saying that the overall environment for all central banks becomes really tight. I think the G3 monetary policy still remains easy because 2 major central banks remain in easing mode.
But wouldn't that mean outflows from India, because the differential trade would then just expand on one side?
I would say that would depend a lot on what happens to the yield curve in the US. If it steepens considerably, then that would lead to outflows. But if it's a flat yield curve, then it would not matter as much. And second is how does the Fed communicate? Does it sort of communicate a very hawkish stance which sort of riles markets, or is it well communicated and the strategy is a gradual rate hiking cycle? There would be some capital outflows from India, but I think it's been well telegraphed for some time that the Fed is going to hike. So unless there is a change in that momentum or in the curvature of the yield curve, I can't see a sharp sort of outflow from India.
Okay, last question then. Given the tentative environment, and it seems a bit tentative, and as you pointed out, things are looking less benign for 2016. Now, you still think that India would hold out among emerging markets? That's still looking likely, given the structural reforms and the focus that there is by the government to push growth?
Yeah, I would say so. I think India's rebalancing started all the way in 2011. So we're already 4 years into a slowdown, and we're seeing a cyclical upturn right now. And that cyclical upturn can continue in 2016 because it's largely led by domestic factors, by policy, fiscal and monetary policy, and by an urban consumer which is finally beginning to spend. So that's what.
Okay, thanks, Tushar. Thanks very much. All the best for the future.
Okay.
Thanks.
Cheers.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.